Hello my fellow investors and welcome back to another stock analysis video. Today guys, we are going to be taking a look at the company Meta, which was actually known before as Facebook. Now this one was brought up by Elizabeth Shelbourne 11 days ago, so I'm really sorry I'm just getting to this now, but you know, I'm getting to this now. I'm so terribly sorry. But she pretty much said, can you please do one of the videos on Meta? Some people believe Meta's dead and others are buying at the current share price to average down in the hopes of the future of the metaverse. She also said, that's another one bleeding in my portfolio. So let's actually take a look at this company, guys, see their fundamentals, and maybe at the current share price if we would like to buy, as she said other people are doing. So with that said, let's get started with this analysis. Now guys, something interesting about this company is that they're actually having their earnings report coming out on the 26th. So when this earnings report actually comes out, I would actually like to revisit this video, look at their earnings report, and then make adjustments as per the earnings that they are releasing on this date. So be on the lookout for that one on the 26th of October post market. But with that said guys, let's come into the calculator. We got the ticker symbol for META, Meta, market cap of $359 billion with a PE of 11.06, which is really small, guys. Current share price of $133.45. And when she said that this company has just been falling, she was not wrong. On the 1 year, they are almost down 59.5%, and on the year to date, they are down 60.6%. On the 52-week range, guys, you can clearly see that this is definitely a 52-week low company with the highest point of $353.83. So this might actually be a pretty good buy at this current share price, assuming that their fundamentals are looking solid. Now, they do not pay out a dividend, which means that all of their cash flow, guys, is going straight into themselves, meaning that we should see the shares outstanding as well as the debt really small if they are doing this correctly. So let's actually analyze now some fundamentals, starting of course with the net income. This is actually looking really good, guys. 5 years ago of 15.9, essentially $16 billion. 1 year ago of $39.4 billion, increase of 147%. So you can see they only had one bad year 3 years ago. Now COVID happened 2 years ago, but then again, everybody was probably online, so they made a lot of money, as you can clearly see, and it's kind of justifiable. So aside from this one off year 3 years ago, guys, this is looking really solid. I'm gonna essentially give this like a 95%. Coming now into the free cash flow, we got 5 years ago of $17.5 billion. 1 year ago of $39.1 billion, increase of 124%. with an average of $23.36 billion. Now, looking at this graph, guys, this is looking really solid. Two things to note though, they came down 4 years ago to $15.4 billion. And on top of that, guys, they did a massive jump from 2 years ago to 1 year ago, going from $23.6 billion to $39.1 billion. That to me is a little bit concerning. I don't know if this will be replicable this year, but nonetheless, it is an outlier, so I have to take that into account. Overall, I'm going to give this, guys, like an 80%. Coming now into the revenue, we got 5 years ago of $40.65 billion to 1 year ago of $117.9, essentially $118 billion, increase of 190.1%. Absolutely insane, guys. This is looking really smooth, really solid, consistently increasing. A little bit too much of an increase for my liking 2 years ago to 1 year ago, but it's not looking too bad. I'm gonna give this a 95%. In regards to the assets minus the liabilities, if we subtract them, we essentially see if the company is able to go through an economic downturn, as we are currently seeing right now. Currently, guys, they have $125.7 billion, which is a lot of money, guys. And even with that, you can see they stagnated around 2 years ago, where they reached their peak at $128.3 billion. And ever since then, they have come down all the way to, as I said, $125.7 billion. But guys, even though this is down from their peak, it is still an amazing amount of assets that they have valued at minus the liabilities. Average assets, we get a whopping $135.1 billion. And liabilities doesn't even get to 30 billion, guys. Their liabilities is only at $28.6 billion. And doing this difference, they're still left with $106.4 billion. Guys, I'm gonna give this essentially like a 90%. Now looking at the cash flow minus the liabilities, I believe the last time I analyzed this company, we did not have this graph, but now we do. So let's actually see if their cash flow is able to cover their liabilities. And wow, this is actually really surprising. As of 1 year ago, guys, they're at negative $2 billion. And well, even though this is bad, take a look at this, guys. 5 years ago and 4 years ago, they were in the positive, meaning that they could have taken all of their cash flow, covered all their liabilities, and still have left $7.3 billion in the positive 5 years ago and $2.15 billion 4 years ago. Now, again, we did see something funky going on 3 years ago in the form of the net income, and we see this here as well, where 3 years ago they went to negative $11.11 billion. But guys, ever since then, they have been bringing it up, which is actually not too shabby. Overall, their average cash flow minus the average liabilities is essentially $2.2 billion in the negative. So it's actually really, really great, guys. Overall, I can't get this at 100%, but I will give it a very, very good score of like at around an 85%. Coming now into the shares outstanding, the most underrated of all the profit metrics. And unfortunately, when it comes to companies that don't pay out the dividend, companies tend to essentially issue a ton of shares when they do not pay out the dividend. Now, surprisingly enough, this is not the case with Meta. We got 5 years ago of 2.9 billion shares to today of 2.697 billion shares. That is a massive decrease of 7.2% on the 5 year, and then from the previous year to the current year, that is another pretty big decrease of 1.61%. Overall, guys, as you can clearly see, there hasn't been one single year where they actually issued shares, and they did a pretty good buyback from 2 years ago to 1 year ago. So overall, I'm going to give this a 100%. Now looking at the cash and equivalents, they currently hold almost $12.7 billion with an average of $14 billion. So now taking a look at an overview of all of their fundamentals, guys, their net income, really solid, 95%, free cash flow, 80%, revenue, 95%, assets minus liabilities, 90%, cash flow minus liabilities, 85%, shares outstanding, 100%, overall grade, guys, a 91%. Yeah. That just goes to show that, you know, mega cap companies didn't get to go mega cap for no reason. They're still printing money as it stands, even though their share price has just completely crashed. But just because their fundamentals are looking good, guys, doesn't necessarily mean that at the current share price of $133.45, it is a buy. Now, a lot of people have been buying it at this point, but let's figure out if that's actually the case. Well, just looking at the discounted free cash flow, guys, without putting any assumptions, the base, not adjusting for debt, it is at $205. And adjusting for debt, this goes up to $416.44. Now, before you guys tell me the share price has never been above $353 this year, how could it possibly get to $400? Well, that's actually really simple. This price that you're seeing right here, guys, is not what the stock price should be. It is the intrinsic value of the company. In regards to the cash and equivalents and their net debt, they're actually really good when it comes to this difference, bringing the share price more than $200 up. So yeah, now let's actually make some assumptions. Looking at the revenue growth forward in Seeking Alpha, it's at 15%. Now, I don't believe that to be the case. I'm going to be fairly conservative when it comes to this. So I'm going to say for the low assumption at around like a 7%. For the median, let's go up to 9%. And for the highest one, let's go up to 11%. Now for the share buyback, we did see that on the 5 year, they're buying back around 7% of shares. So let's actually do this a little bit less, right? Let's just assume that they won't do 7%, but let's say that they'll do it around 3% for the low one. Let's say at around 5% for the medium one, and let's go with 7% actually matching what they have done within the past 5 years for the high assumption. Now, with that, guys, we get the target share prices of $271 essentially for the low assumption. For the median, it is $296 essentially, and for the high one, it is $322.73. Adjusting for debt, guys, this goes up massively to $546.80 for the low assumption, almost $597 for the median, and $650.51 for the highest assumption. Now, doing a margin of safety of 5, 10, and 15% for the low one, this puts me between the ranges of $464.78 to $519.46. For the median, $507.15 to $566.81, and for the high one, almost $553 to almost $618. Yeah, guys, at the current share price of $133.45, this is looking like a pretty good buy. Now, obviously, You guys are saying these are massive numbers. Well, remember that every investment is the present value of all future cash flow, and of course, this is not financial advice. Most of you guys are probably looking at this and you're already discounting me on it. No problem, that's fine. You can have your opinion. But for all of those of you who understand how discounted free cash flow works, understand that essentially when you change any of these values, you're essentially going to be changing all of these values as well. For example, let's say that you don't believe that at the highest point that they'll grow at 11%. Let's just say that for example purposes that you think that they'll do 3%. Let's just say that you really don't like Facebook at all, and that you think that essentially they're going to be buying back shares at around like 2%. Keeping the same margin of safety, guys, now it is $233.63, not adjusting for debt, and $472.06 adjusting for debt. So you can clearly see it does change a lot based off of what you believe. That's why, again, this is not financial advice, and every investment is the present value of all future cash flow. Have these calculators for free, guys. Make your own assumptions. I also have, just in case you guys don't believe that this kind of free cash flow, you can also use my book value calculator, my reevaluation calculator, and a dividend tracking sheet, which this company doesn't pay out the dividend, but for those that do pay out the dividend, you can use this as well. I have videos in how to essentially fill all of them out, and I will be updating the dividend one fairly soon. But nonetheless, guys, again, have these calculators, have free content. All I'm asking for in return is just help me grow my channel, like, subscribe, comment. That is the best way that you can support me in my endeavors I am doing. So again, no sponsorships, no affiliate links, just grassroots effort. Help me grow my channel, like, subscribe, comment. It really does help. All in all, guys, when it comes to Meta, I gotta say, at the current share price, it is looking good. I get that right now, that's another one that's bleeding your portfolio, Elizabeth. But then again, every other company has also fallen down. The S&P 500 is down 20% or more as if you're seeing this video. So it's not just Facebook, it is essentially every other company is also going down as well. I mean, just take a look at Apple. So I wouldn't worry about this too much. Obviously, not financial advice, but you just saw the fundamentals. It does not look too bad. So that's essentially what I have to say for this company. Really, really solid. But that pretty much does it for this video. Liked if you like, comment, subscribe. It really does help her with the algorithm on YouTube. You guys can follow me and my new tech sites. Link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video.